XRP is sitting in one of the most interesting positions it has been in for a long time. On the surface, nothing looks exciting. The price feels slow, the movement looks weak, and for many people, it almost feels like nothing is happening. But if you look a little deeper, you start to realize something very different is going on. This is not inactivity. This is pressure building. And historically, when markets enter this kind of phase, it doesn't stay quiet for long, because what looks like silence on the outside is often preparation on the inside. Right now, a major shift is taking place at the policy level. Conversations that were once uncertain are becoming more defined. Arguments that once created fear are starting to lose strength when tested against real data. And when narratives begin to weaken, the entire structure around them starts to change. But here's the key thing most people are missing. This situation is not really about one product, one asset, or even one sector. It's about control over financial infrastructure. It's about who gets to move money, how that movement happens, and which systems will dominate the next generation of finance. And that is exactly where XRP enters a conversation. Because while most retail investors are focused on short-term price movements, larger players are focused on long-term positioning. They are watching regulation, compliance frameworks, and structural shifts that determine whether capital can move freely into a market. Right now, one of the biggest barriers holding institutional money back is not lack of interest. It's lack of clarity. Institutions don't operate on hype. They don't chase speculation. They wait for rules, definitions, and legal certainty. And once those pieces fall into place, their behavior changes very quickly. That's why this current moment matters. Because a discussion around digital asset classification is moving toward resolution. And when uncertainty begins to disappear, risk perception changes. When risk perception changes, capital allocation changes. And when capital allocation changes, markets move. But here's where it gets even more interesting. While all of this is happening in the background, the fundamentals supporting XRP are quietly strengthening. The global financial system is still heavily dependent on outdated infrastructure. Cross-border payments remain slow, expensive, and inefficient. Transactions that should take seconds often take days. Costs that should be minimal remain unnecessarily high. This inefficiency has existed for decades. And now, solutions are emerging that directly challenge that system. XRP is one of those solutions, not because of hype, but because of its design. Fast settlement, low transaction cost, and scalability are not just technical features. They are solutions to real problems in global finance. And those problems are not small. They exist at a multi-trillion-dollar scale. Now think about what happens when a system designed to improve efficiency starts gaining real-world attention. It doesn't replace the old system overnight, but it starts integrating. Testing begins. Adoption slowly increases. And over time, the shift becomes unavoidable. That's exactly the stage we appear to be entering now. Real-world assets are beginning to move onto blockchain-based systems. Financial institutions are experimenting with tokenization. Infrastructure is being built quietly, without the kind of hype that usually attracts retail attention. And yet, despite all of this, the price has not fully reacted. This is where most people get confused, because they expect price to move first. But in reality, fundamentals often move before price does. And when that happens, it creates a window of opportunity, a phase where the market has not yet fully priced in what is developing beneath the surface. That phase doesn't last forever. It ends when a catalyst arrives. And right now, the most important potential catalyst is regulatory clarity. Once clear rules are established, institutions no longer need to hesitate. Compliance barriers are reduced. Internal restrictions are lifted. And capital that was waiting on the sidelines gains the ability to enter. And when institutional capital enters a market, it does not move slowly. It moves with size. At the same time, another important factor is developing: supply dynamics. More assets are being moved off exchanges into long-term storage. This reduces the amount available for immediate trading. In simple terms, supply in the open market begins to shrink. Now combine that with potential increases in demand. Lower supply plus high demand creates imbalance. And imbalance is what drives strong price movements. This is basic market structure. And it becomes even more important when you realize that large holders are not exiting positions. They are accumulating. They are positioning. They are preparing for something that has not fully happened yet. Meanwhile, on the retail side, the experience feels very different. There is frustration, there is doubt, there is hesitation. People look at the chart and wonder if they are missing something or if nothing is actually there. And that feeling is completely normal, because markets are designed to test patience before they reward it. If you look across different asset classes in different cycles, you will notice a repeating pattern. The period of maximum frustration often appears just before a major breakout, not because of coincidence, but because that is when weak conviction leaves the market and stronger positioning takes its place. Now look at what has changed recently. Discussions around regulation have accelerated. Institutional awareness has increased. Real-world use cases have become more visible, and the overall narrative is shifting from uncertainty toward possibility. None of this guarantees immediate results, but it changes the probability of future outcomes, and markets respond to probability long before certainty is reached. That's why the most important question right now is not about exact price targets. It's about positioning. Are you positioned before clarity arrives, or are you waiting for confirmation after the move has already started? Because by the time everything becomes obvious, the market has usually already moved. Right now, XRP appears to be in a compression phase, a phase where movement is limited, but pressure is increasing. And when pressure reaches a certain point, release becomes inevitable. When that release happens, it doesn't move slowly. It moves decisively. And often, it moves faster than most people expect. So the real challenge in this moment is not prediction. It's discipline. It's the ability to remain patient when the market feels slow. It's the ability to stay focused when noise increases. And it's the ability to recognize that quiet phases are often where the most important developments occur. Because the financial system is not static. It evolves. It adapts. And when new systems prove to be more efficient, more scalable, and more effective, they gradually begin to replace the old ones. That process is already underway. Not loudly, not dramatically, but steadily. And assets positioned within that shift tend to benefit the most over time. So instead of focusing only on short-term movement, it becomes more important to understand the bigger picture, to recognize the difference between noise and structure, to see beyond daily fluctuations and focus on long-term direction. Because in markets like this, the outcome is often decided before the move becomes visible. And when the move finally arrives, it doesn't wait for everyone to be ready. It rewards those who prepared early. So the question you need to ask yourself is simple. Are you reacting to what you see right now, or are you preparing for what is developing beneath the surface? Because what happens next may not just be another small move. It could be the beginning of something much bigger. And moments like this are usually only obvious in hindsight.